45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Welcome everyone to our online event today, the ultimate guide to single family versus multifamily investing. My name is Christy Dietz. Let me get to the next slide here. No, why it's not letting me go to the next slide. You want to switch it, Chris? It's not letting me.
Yeah, sure.
Okay, for some reason my clicker stopped working. My name is Christy Dietz, and I just want to introduce myself briefly. I moved here to Los Angeles in 1995, and I've been part of Marshall Reddick since 1996. First as an investor, and then an agent and educator for Marshall Reddick. I've been an agent for 25 years, and I've sold over 500 properties. I grew up in Sarasota, Florida, and graduated from Florida State University. And over my time with Marshall Reddick, I purchased 24 investment properties through Marshall Reddick. I still have 11 of the properties today. Many of them are still managed under Marshall Reddick. I am also a Marshall Reddick mortgage fund investor, and I do work a lot with builders, developers, investors. I project manage jobs. I kind of grew up on job sites in the construction industry. My dad was an engineer and builder, so I was always around it. I have 2 college-age kids, Harrison and Olivia. One's about to start law school, and the other one is in STEM and going to be a doctor. I do have 3 dogs. 2 are rescue dogs. I'm a huge animal advocate and volunteer here in LA and also in Africa with rhinos and elephants and things. And just we've had so much going on this last week with the Los Angeles fires, and I've been actively involved all week rescuing animals, from mini horses and pigs and dogs and you name it. So thank you everyone for being on this event, because I know it's been kind of a lot of anxiety and stress for everyone, anyone at least who's up here in Los Angeles.
Absolutely. Well said, Christy.
Oh, it did work. Okay, good. The topics that we will cover. So we're going to talk about the status of mortgage interest rates. We're going to have the multifamily pros and cons and why that's important. Multifamily financing and how that differs from single family financing. Also all about single family, the pros and cons of owning that as an investment property. Chris and I have put together a couple current property picks for you to look at, and the benefits of property management, which Chris also works in business development, and he deals with the property management day in and day out, and I deal with the leasing part of it. What we expect from you as an attendee, we just would love for you to learn and take notes. And if you want to send us a chat, I have my chat message open. If there's one particular question you want answered that we're not answering, please write down any other questions you have for further discussion, as Chris or I will reach out to you after this event and see if there's any other things that we can help you with, and be ready to write down any of the links that we share with you throughout this event. Not going again. I don't know why it's, oh, there we go. Okay. So Marshall Reddick, we are full service to you. We're a full real estate brokerage. We are a property manager. We're a private money lender. We have an investment fund. Most of you probably know we've been around since 1979. So we have done this for a long time, and we really make it possible for you to purchase real estate investments in carefully selected areas that we have tested, and we know all the demographics on in the United States. And we provide everything for you, from real estate brokers, contractors, property managers, access to top resources with our lenders and private mortgage fund, accountants, CPAs, insurance agents, attorneys, and everything that you could think of that could help you. We have a national footprint. We have boots on the ground here in Los Angeles and Newport Beach. And then we have 5 offices in Texas now: Dallas, Austin, Houston, San Antonio, and New Brunswick, We also have offices in Clarksville and Nashville, and then also one in Cape Coral. So how do we choose where we invest? There are seven different things we choose as our criteria. Number one, the job market is very important. Are they adding more jobs? Are jobs being taken away? Is it what type of jobs? Are they part-time job, full-time jobs, etc.? What's the vacancy rate in that area? Obviously, we want a lower vacancy rate, so that makes our properties more desirable. The economic diversity of the area, the housing affordability, that is a really big factor in when we're looking at investment properties. Is it a landlord-friendly state? Is it easy to get tenants out if they do anything in the property or they're not paying their rent? Is it a strong education? I always look like what type of universities are in the area. What's the rating of the school district? And also, is there reliable property management in the area? And obviously, Marshall Reddick has the best property management around. This is just some of our staff in our different offices. We have about 150 employees right now, not counting our support staff, but you can see our largest contingent is there in the center, our Los Angeles and Orange County offices, and then all of our subsequent offices and all of our staff around there. Next.
Thank you, Christy. Thank you for the introduction. I think Christy's last slide is my favorite slide. That's our team all across the country from East Coast to West Coast. I was just out in Texas hanging out with a bunch of our team in New Braunfels and San Antonio and Houston. And it just kind of takes a village to operate real estate investment properties, everyone from property managers to CPAs to realtors to marketing folks, private money lending. So we just do a really fantastic job of putting it all together for you guys for a one-stop shop here at Marshall Reddick, as Christy mentioned. My name's Chris again. I work in business development and also as an advisor to our investors who are looking to invest all over the country in the markets that we're in. I've been licensed as a real estate broker and agent since 2013. I went to University of Kansas and then cut my teeth in real estate in Chicago before moving out to sunny Southern California a few years ago. I've done plenty of sales transactions, leasing transactions. I've mostly just focused though on the investor side of things. I've had some experience with fix and flip, buy and hold, value add, multifamily stuff. I'm just kind of had my fingers in lots of different pies, I suppose you could say, within real estate investing. And I personally own investment property out of state, specifically in one of the markets that we manage. I have an investment property in San Antonio. So I invest in the mortgage fund too. It's a great way for passive income if y'all are looking for something a little more diversified away from stock portfolios, although the stock market's been humming along pretty well, and I think will continue to do so for a little bit longer. But the mortgage fund is a really, really safe, stable asset that's disconnected from the stock market. So without further ado, I'd love to chat more about why we're here, which is looking at multifamily versus single family investing. But I want to give a little State of the Union update from Mr. Reed Hazard, straight from his mouth. He's our preferred lender. He's kind of a partner to Christy and I and to many, many, many people here at Marshall Reddick. He's worked with thousands of our clients, I think, over the decades. And I just took this straight from Reed, which is our most recent interest rate update. And just to quote him exactly, a wide range of major economic data released this last week was stronger than expected, which increases future inflationary pressures. As a result, mortgage rates climbed to their highest level since April. Over time, we believe rates will come down again, but not to the levels prior to the pandemic. I don't think any of us really think we're going to be seeing, 3s and 4s here anytime soon. Rates are likely to stay in the range of 5.75 to 7.25 for years to come, with hopes that lower 5s are possible for primary residences with the new political administration, straight from Reed here. So, it's not all doom and gloom, guys. We're going to look at some really interesting options for real estate investments that allow for capturing lower mortgage rates. Specifically,
can I just say something on that real quick?
Get in there.
I told you earlier, I bought 24 properties through Marshall Reddick. And when I first started buying, all of my properties I bought were 8 and 9% interest rate. Because it was in the, I started buying in the like 1997. And I didn't think anything of that. I didn't think anything of 7.5%, 8.5%, 9% interest rate. And then as time went on, I always just ended up refinancing all of them or doing a modification and getting the interest rates down. So don't ever, like these rates to me still look really good.
Yeah, well,
When I bought it,
you know as well as I do, it doesn't matter what the rate is as long as the deal works, right? As long as it makes sense, as long as there's enough rental income or enough upside opportunity. Marshall Reddick is a private money lender. Go on our website and look at our rates. They're going to make that 5 to 7% look pretty tasty. We lend at 8 to 12% for private money financing to short-term fix and flippers, to developers, and those folks are extremely successful at what they do. And they're happy to borrow money at 8%, 9%, 10% because it allows them quick access to capital to close on the deal. That makes a lot of sense when you run the numbers. So great point. I absolutely agree. As long as the numbers work, but they certainly can be helped along with lower interest rates. That's without a doubt. There's very interesting partnerships that we have with builders across multiple states that are willing to buy down the interest rate. So that kind of brings us right in line with why invest today versus waiting longer. Well, right now we've got a unique position where there's a lot of inventory on the market. A lot of developers, in specific locations. Obviously, if you're sitting in California, you're probably looking around going, where's all the inventory? Especially after, not to be glib, but the most recent fires. So we're in a total lack of inventory over here in Southern California. But in other states where they can build, there's cheaper land, less building codes, and they're able to get, stick ready new construction built homes. They built a lot over the last few years when financing was cheap. And what that means is when interest rates spiked for primary residences, it kind of dampened demand in those markets. And now those builders are sitting on new built homes that they need to sell. And so we're looking at those folks, knowing that they're eager to get rid of inventory, and we're finding really good deals. So that brings me right in line with seller incentives. Those developers are offering very, very significant and compelling seller incentives, like buying down the interest rate to, in some cases, 4.25. We're going to go over a couple of different products in Texas and Tennessee that have lower rate buy downs. And of course, everyone knows this, you have the ability for refinance in the future. If you do get a loan with REID, you can get what's called a rate rebound, which is a free refinance. And right now, because of the additional inventory in a slower market due to elevated interest rates from 2 years ago at least, you're buying at a better price. And ideally, you're holding on to these assets for 10, 15, 20 years. I mean, Christy, how long have you owned most of your real estate for?
Well, I started buying in 97, and then I kept buying all the way till 2005. And then I stopped buying for a long time and just let a lot of my properties grow. And then I sold some of them, and then I started buying again. So I just bought last year again. So
perfect.
A long time.
You're dollar cost averaging in a way, right? You're just continually buying, which is fantastic because it covers you across all different types of markets, and you're buying in the dip, and selling high. So thank you for your input there. I always like to ask Christy because she owns 20 something residential real estate properties, and that's a tough thing to do. So always good nuggets of information to learn from Christy. Well, let's talk about why you might be interested in multifamily. We're going to talk about the pros and cons of each here. I think a big pro is economies of scale. When you buy a duplex, you're getting 2 doors, and when the price per door is typically substantially lower than single family rentals. There's duplexes in Austin that we have been selling for around $600,000 to $650,000 right outside of Austin. A single family home in that same market typically around 400,000. So for a similar size, similar quality of construction in an A-class neighborhood. So for 600,000, it's basically 300,000 a door versus you'd have to buy 2 of those single family homes totaling 800,000 to have 2 doors if you just bought single family. Generally speaking, there's less competition for multifamily, especially the more units. There's less buyers out there chasing multifamily deals versus single family homes. Most folks don't want to jump in on their first investment with a 2 unit, let alone a 6 unit or an 8 unit. So you're going to run into a little less competition, and typically you're going to get higher cash flow. Multiple doors allows for more cash flow and more insurance of income for owners, which we'll get into here in a sec. Economies of scale, this is a really nice breakdown. If you bought a 4 unit, for example, for $850,000, that generated $6,000 a month of gross income. Compare that to a single family home in that same market that maybe costs $305,000 that rents for $1,850. Well, you'd have to spend around just under $1 million, right? 988,000 here to generate that same amount of income. You'd have to buy over 3 of these things at 300 grand just to get that income of 6,000 from that multifamily. So when you look at multifamily, you might find that, hey, I want a little bit less of a headache when it comes to growing more portfolio versus like trying to find a deal. You go through the transaction process, obviously 4 times, which can be a little daunting when you buy 4 single family homes versus buying a 4-plex. You go through that transaction process once, you pay the agent fees maybe once, title, escrow, all of that stuff, just one time. I always spend tons of hours also identifying markets. So I'll do a, kind of an exhaustive market research, and looking at multiple markets can be a little daunting. So if you guys want to just have 4 doors in one market with one property for ease of time, it's maybe not a bad idea for you. We kind of spoke on a few of these facts here, but one of the cons I would say is it takes a little bit more of an experienced investor to assess and mitigate risks. When you're buying multifamily, a lot of times these properties are tenant occupied. With tenant occupied properties, you got to go over lease agreements, you got to get rent rolls, you got to make sure that the water bill that the owner's paying for isn't, have a water leak, and you got to get meter readings, and you got to make sure that the meters aren't tied together. There's a lot more nuance, I would say, in the deal, and you need to make sure that your tenants are the type of people that you want to inherit if it's tenant occupied. Another factor is limited supply. So finding that deal might be a little bit more challenging, but you're probably going to have a little less competition in the end run because you have less buyers. Now, of course, we have to talk about that it's a higher entry point, right? If you're going to buy $1 million 4-plex or an $850,000 4-plex, I should say, that was my previous example. Yeah, sure, it's economies of scale, but maybe you only have $300,000 to buy a single family house, and that's fine, right? We're going to talk about the pros of single family homes, but that can be a con, as it takes a lot of capital to buy a multifamily unit. I think a big pro here is that more doors equates to more rental streams, and it does improve cash flow, but it also, more importantly, I hear this from multifamily investors all the time, they like the income reliability, in the sense that if one unit goes vacant out of your 4-plex, that's okay. You don't have to pay the whole mortgage on your own. You have 75% of your income stream still coming in, even though you're dealing with a vacancy, and that's not too problematic. Versus when a single family home goes vacant, it's kind of like, oh boy, I got the mortgage coming up here in just a couple of weeks, and I don't have any income whatsoever coming in. So that can be a little daunting for some folks. And then rent increases are multiplied per door. So when one of your rents go up in your building, well, they're all going up, right? So now it's justified as its own comp. Versus if you have 3 single family homes in 3 completely different markets, obviously there's local market dynamics at play. Just because your rent went up in Tallahassee doesn't mean it's going up in Nashville, right? Now let's talk about why single family. I firmly believe single family is a fantastic investment. Affordability, right? You can get into a single family Class A property in San Antonio, Texas for 250 grand. I mean, that's pretty fantastic. I don't know how many Class A single family homes you can get into for 250 grand in Southern California, right, Christy? Nothing near you, right?
Mhm. No.
So appreciation for single family is fantastic because it's driven by the demand of the American dream, right? Most folks in this country want to own a single family home. And most folks do, factually, the majority, over 50% of, tenants are homeowners, primary residents. So I think you're going to have more appreciation over the long haul on a single family asset than a multifamily. Multifamily is tied to increasing rents. And when rents don't increase, well, your value doesn't increase. Multifamily properties appreciation is tied to cap rates, which is just your net operating income divided by your asset price. And it's a little less determinative just based off of market dynamics across demand for primary home buyers. It's also super easy to trade, meaning when you do want to go resell your investment property in 10 to 15 years, you're opening it up to the majority of buyers out there versus a multifamily product. You're just dealing with investors, and investors like to wheel and deal, right, Christy? I know you like a negotiation. So
Yeah.
yeah, I think it's a little easier to get the emotional element involved when you resell your investment property that's a single family home to a buyer, because they're emotionally tied to it because they're going to raise their family. You're going to sell it more than likely to a primary home buyer, which is great. So some of these pros and cons here. This also kind of goes with the financing aspect. You can do a lower down payment on a single family property versus a multifamily in some cases, just to get into cash flow, 35, 40, 50%, depending on the market, is going to be required. But 20 to 25% down payment, totally doable. Most lenders are going to recommend a little higher, 25 to 30, just from a cash flow perspective, but totally okay to do 20 to 25. You have that big buyer pool. And like I mentioned, primary residence buyers are definitely willing to pay more for their personal home. Less maintenance costs potentially. I think that's more than likely true, at least in my experience and my clients' experiences. Single family tenants tend to stay longer. They're a lot less transitory, or they're not transitioning from a 2-bedroom to a 4-bedroom. If they are renting your 3 or 4-bedroom home, they want to raise their family there. If you buy in a good market or a good area, I would recommend a suburban area, low crime, good schools kind of thing. They're going to want to raise their kids in there. If they rent there for the reasons of going to school, well, they're not taking their kids out, right? So they're going to be there for 3, 5, 10 years, and you're going to incrementally raise rates, rental rates. What that means is they're not moving out every year. Versus a multifamily, I've got a multifamily listing in Fullerton where there's a college nearby. It's college kids that rent there. They last 1 year, 2 years. You can get high rents, that's great, but you got a lot of turnover work, that's for sure, when they move out. They tend to party a little bit. So you got to paint every single time. You got to fix appliances, all that stuff. So you get the purchase option both from a primary residence and investor. As I mentioned, multifamily is just going to be that investor pool. And it makes up 69% of all home sales, which is pretty fantastic. You got a huge pool of buyers for yourself. Appreciation, we talked a little bit about this, but I think the interesting aspect here is that most homes are going to be in master plan communities specific to Texas, Tennessee, and Florida markets, which is where we're located, which means when you buy multifamily, okay, you're usually, most multifamilies in a dense area in the urban core, no master plan communities, right? So you might have the best maintained multifamily on that street, but your neighbor, there's no HOA governing them. They can have the car in the front yard and shopping carts tilted over and stuff on the street. That kind of thing happens. But my single family home that I have in San Antonio, for example, is in an HOA. And I got a letter in the mail personally just 2 weeks ago because my tenant wasn't mowing the grass. The grass got like 2 inches long. To me, I love that, right? The HOA's keeping an eye on the market, or keeping an eye on the neighborhood, I should say. And why that's important is because when you do want to attract tenants, well, the whole street looks pretty similar. And when you want to resell, the street looks great. It's really well maintained. We spent a lot of time on this, but here's an actual fact for you guys. The majority of the housing stock in the United States is single family home detached houses. Of the total 128 million housing units in 2021, about 81.7 million were detached homes and 8.2 million were attached single families. So the vast majority of tradable inventory is single family properties. We really do feel strongly that this is a great asset to invest and own long term, because we're also not building enough single family properties. I think in certain markets, there's, just like Southern California, there's really not a ton of options for single families. When it comes to the financing aspect, down payment requirements for single family and 2 to 4 units, 20 to 25%. You can do a 30-year fixed or maybe a 10-year ARM. You have more favorable terms, meaning less upfront costs for closing costs and points, things like that. Longer fixed terms and no prepayment penalties, meaning you don't have a balloon, right? Or at least most people don't. I wouldn't opt for one, that's for sure. However, multifamily, once you get into the commercial lending product, you got really big down payments. In today's rate environment, 25% is very unlikely. It's going to be a lot closer to like 40 to 45, 50% on what's called a DSCR loan, debt service coverage loan, commercial product, where the income covers the mortgage payment, right? Most lenders want to see that. So more loan products are available to you. You can do ARMs, interest only, DSCR, debt service coverage ratio loans on multifamily. So you got a variety of options. You can get really flexible with terms, but it's really expensive to buy those that flexibility. You have more loan costs, more points, and you have early payoffs. You get big balloons coming up. Commercial oftentimes is on 5 and 7 year balloon payments, which is a little bit scary. And you got to refinance, and if rate environment changes like it just did, well then, you know, it's a little tragic when your rate goes from 3% to 8%, right? So I would say the financing aspect is often a big turnoff for those that are looking at 5+ units. Personally, I think if you guys are in that, you know, I own a couple of properties and I'm thinking about multifamily, that 2 to 4 unit is a really great sweet spot, because you get best of both worlds, and you also get much more approachable and palatable financing. Now, I don't think any of this really works very well without property management. Property management is how we maximize your income from the asset. I always tell investors that I'm consulting, you know, kind of like 10% of the work is the identification of the market and buying the property, closing the deal, getting the financing done. But in all reality, the last bit, the other 90%, the majority of the work is holding on to this thing for the next 10, 15, 25 years, like in Christy's case, right? You're buying in the 90s and she still has some of these. So a lot of that work is in the property management. And so you want to hire a really good team that understands how to select tenants, how to make tenants rent or make properties rent ready and attractive to tenants so that they want to live in them long term, how to design lease agreements, how to check income and landlord references and all that good stuff. And of course, enforce the lease, how to find great vendors that don't rip you off, and you know, make sure that we're inspecting the property every year and not letting your investment go by the wayside. So property management is a key element, in my opinion, to a successful investment portfolio. And honestly, the majority of folks that we work with, that Christy and I work with, have very demanding day jobs. They have families, right? And spending their hours and hours a week on their investment portfolio is really not going to benefit them. Hiring a property manager, it's on the long run going to be a lot less time intensive, so they can spend that time making more money in their chosen profession or more time with their family. So here's just a snapshot of our property management fees in our Texas market and Florida and Tennessee market. We have a different fee structure local for Southern California. If you're interested in property management, whether or not you're going to buy property with us, you just are curious about our services for property management in Texas, Florida, Tennessee, or California, definitely contact Christy and I. Will be happy to jump into more depth onto all of our fees and how we handle our property management and our philosophy. But without further ado, I want to just go over a few different properties that we have here to show you guys, and just kind of a comparison and contrast different markets and different styles of properties. So this very first one here is a duplex in Buda, Texas, which is right outside of Austin, about 20-25 minutes away. It's listed for $615,000, and with a down payment of 30%, it's going to cash flow pretty well, about $650. The developer is actually offering some incentives here. They're offering 1 year's free property management. So this is with a 0% property management fee that first year, and they're offering an interest rate buy down of all the way down to 4.25. So you guys can get a 4.25 interest rate, which is pretty unheard of. So looking at taxes, insurance, HOA fee, there's a little HOA actually in this community, which I really like. Tenants pay utilities and there's no landscaping cost. You're looking at a really nice, healthy, cash flowing duplex right outside of Austin, which, as we all know, is a growth market, tech hub for the Southwest in Texas. And this is a really nice family-friendly community. I was just there with the team touring all of these properties a couple weeks ago. It's really, really well maintained. And the way that I really appreciated the developer's insight into how this would be a good tenant-friendly property is that the doors on either side are on either side of the building to enter into each individual unit. So the tenants aren't running into each other. It feels like a distinct single-family home. In the back, the yard is separated by a fence, and you and your neighbor don't really have to hang out if you don't want to. You have your own private space. So these units are like 1,800 square feet a pop, or this one's 1,676 square feet. We do have ones that are around 1,800 square feet. And they, like I said, they live like a single family house, which means your tenants are going to want to stay there long term, and especially since then it's in a good school system and a nice, safe community. But your 15-year annual ROI on this is around 23%. So that means we're taking into account historical appreciation of the Texas market, specifically, the Austin suburban market, along with the cost of selling when you do sell in 15 years, along with your anticipated cash flow and all that good stuff. We don't anticipate increased rents just because we want to be very conservative. And we also chop a little bit of the appreciation down to be more conservative and in line with what our expectations are for duplexes. Same factors are in play here with this particular property, meaning we're going to look at the same data, but this is a local property in Fullerton. This is a listing I have. I think some of the data is kind of skewed here, not skewed, but missing in the fact that the list price is $2 million on this one. So this is a 4-unit for $2 million. Each unit costs $500,000, which is, almost the cost of this brand new construction duplex and right outside of Austin. So the mortgage payments, there's no interest buy down from the seller. It's just an individual seller, not a developer. It's an older property. So it's around like 6.5%, 7% potentially. If you're getting a mortgage, just to get it to cash flow, you got to put $1 million down. So that's kind of the state of the market here locally, is that for you to cash flow with today's interest rates, it requires a very, very, very hefty down payment. Whereas in other markets, you can put 30% down and you can get that property to cash flow really healthily. So I like showing people out of state versus in state. It's very expensive to own real estate investment properties in our particular market, and there's a lot of options in other markets that we have a big presence in. This is one in Florida, just another market that has some cash flow potential. I really like this developer. They put a lot of attention into making this a hurricane-proof property. So they build these on higher elevations. They build these miles and miles away from the coast, and with really high standard building quality to today's code. Wouldn't probably recommend buying properties down in Florida right off the coast that were built 40, 50 years ago, but these things are going to withstand the test of time, and they're in an X flood zone, meaning they're not in a flood zone. This is actually a property that Christy chose. I'd love for Christy to talk a little bit more about this one.
Okay, so this property is actually a really great deal. So one of the little bit of the differences we have here in Los Angeles from maybe other places in California is a lot of you might know who are up here, but we have a lot of properties that they're building. You have your main house and they're either taking a garage and turning it into an ADU, which is an accessory dwelling unit, or in this case, they left the garage as is and they just built a whole other structure in the back. So you actually have 3 properties on one. And he had it listed for $1,550,000, which is about the correct price that he should have it sold for. And now it's all the way down to $1.3 million. So it's actually really a good deal. And the rents are not, I'm trying to pull up what I have here. The rents are not like where they should be either. He has the rents a little low. And the good thing is, and all of these were done brand new in 2020. So although the house says that it's a 1956 house, they're actually a newer house, because when they redo this, they make them, do everything from scratch. And you can see the building in the back is a 2-story building. So the back unit is a duplex in essence, and then the front unit is the main house. So the main house is 4-bedroom, 3 bathrooms, and it has a 2-car garage, and it was completely redone in 2020 with all new roof, new electrical, everything. Everything new inside, stainless, quartz counters, the works. And then that lease ends like March of 25. And then there's a 2-car garage, and then there's 7756 and 7756 and a half Delco, again, all fully permitted. The one, it's a 2-story ADU divided into 2 apartments. So the one smaller apartment is 500 square feet and the other one is 700 square feet. And again, all brand new construction in 2020. Now his rents are a little bit low on these, I feel like, but they are, those units are month to month as well. So there's a great upside opportunity for people. What I'm seeing a lot is a lot of people in Los Angeles are buying multifamily or houses with multiple homes on the lot, because, the one family might live in the main house and then they'll put their mother and father in one of the other houses, and then maybe a relative in another house, or they'll use 2 of the houses, and the 3rd house or the 4th house, they'll rent those out. So we have a lot of these in Los Angeles. They've been built. There's also an SB9. I just put one on the website today that the lot is 20,000 square feet, and they have multiple houses built on there, but you can build at least 2 more houses on the property and then lot split the property. So there's a lot of opportunities for these type of housing in LA, which is very, very different from what you'd find in Orange County or other places in California, or even in other states. They just really don't do like what we're doing here. And it's because of our housing shortage. That's what I have to say about that.
Absolutely. Yeah, no, thank you, Christy. I think you hit the nail on the head. That's why I think this would be such an attractive investment property for a prospective owner that wants to hold on to something for the long term and provide much needed housing. It's because there's just, the cost of housing is so outrageous out here now that getting in for a single family home rental is really challenging. So people want to put their whole family into, a compound essentially, right? And live in multiple structures at a kind of a discount. So I think that's a really good play for a long-term owner, is to see that writing on the wall, is that you're going to have more people looking for that type of living situation. So right
now with 16,000 houses that burned down, oh my gosh, it's, everything's going to be at a premium to try to find. No one can find any rental properties right now. We have such a massive, even more than before.
Yeah, if you're on this call and you're an owner thinking about converting a property into a rental here locally, this is the time to do it. There's a lot of demand for sure. So
And you'll be helping people who need it.
yeah, I just met with 2 owners that had never rented out their properties in LA, one in Pasadena, one in Silver Lake, and they're trying to put their homes on the market for rent because they understand that this demand is exceedingly high, and it's you know, a really good time, I think, if you're thinking about helping somebody out. So now I wanted to choose this property in Tennessee. It's a new construction property. It cash flows, and the reason I like it is just a juxtaposition to Christie's property pick, because this entire asset cost is less than the capital needed to buy that other property that Christie's shown. So you only need about $94,000, and this whole property costs, you know, under $300,000. So new construction, it's going to rent quickly, it's going to rent to a family, and it's going to have very little maintenance over the next, you know, 10, 15, 20 years. Christy, if you want to take us from here and talk a little bit about the property rating ebook, that would be great.
Yes, actually, I have it right here. And this book is amazing. It's like 38 pages. And I would highly, highly suggest that you read this from cover to cover, because this really teaches you how to choose the best real estate investment properties, how to identify it, how to classify it, and how to apply these things to purchase the property. I feel like it's one of the best publications that we have. I mean, it's just really amazing. And you can get this by just going to our website, marshallreddick.com/ebook, and you can download that for free in PDF format. And I highly suggest that you do that.
Yeah, absolutely. I think understanding property classes, when we say property classes, we mean A, B, C, D property classes. How is that derived? How is that understood? And how can you calculate for that? So we break that all down. If you're interested in, you know, reviewing that ebook or have any questions about property classes and how to, you know, how do I identify my property class that fits my goals and criteria, reach out to Christy and I. This is how I sum it up really quickly: is A-class properties are for appreciation, right? They're going to be the top of the market, best schools, highly desirable properties that are going to go up in value, but they're typically not going to cash flow as much because of how much capital it costs to attain them. B-class properties, solid neighborhoods, you know, that's going to be your middle management folks that are moving in there. Those are going to be a bit of both, bit of cash flow, a bit of appreciation. C-class, that's cash flow, and D-class stands for don't do it. So
that's true.
Yeah, to stay away. That's typically going to be
C-class, like the appreciation is very slow on it.
Yeah, C-class is cash flow focused and not appreciation focused necessarily. D-class is going to be, you know, you might think you're getting cash flow on paper, but my goodness, you're going to have a lot of headaches in the long term. Those are typically the highest crime areas, and, you know, government subsidized housing, that kind of thing. So that's a very challenging investment niche for sure. But I definitely recommend you all, just as Chrissy said, the ebook is a really important guide, but it's not the only guide. We've got thousands of videos and articles and guides on our website, and it's all for free. It's pretty amazing. If you want us to specifically review questions that you have, we can show you how to find guides on 1031 exchanges, and we'll be able to consult you on that. Christy and I have gone through 1031 exchanges, you know, personally with our own properties, as well as helping our clients go through that process.
Instead of scrolling YouTube or social media, you can scroll the Marshall Reddick site.
Yeah, honestly, seriously.
Literally.
You definitely can. There's
so
just
entertaining.
You know, how to flip properties and, you know, all that good stuff. And that's all done from people that are very experienced doing it, that are, you know, not first timers. So if you are interested in working with us, or any company for that matter, please look at their social media reviews and profiles. We have, I think we're over 2,000 reviews online across Google, Yelp, Zillow, you know, Better Business Bureau. So You can find us everywhere. Read our reviews. We don't shy away from them because we put a lot of the energy into providing an excellent experience for our clients. And you know, those folks are coming back and you know, asking for more and are leaving great reviews. And follow us on social media. We have little pages all over the place. If you've worked with us before, please do write a review. If you're one of our clients and you haven't done so, you know, tisk. We'd love a review from you if you've had a great experience. We really appreciate it. We love the feedback. And as I mentioned, Christy and I are here for consultations. They're all complimentary, and our jobs is to advise you on your next step of your real estate journey. We'd love to learn about your goals, your criteria, and what you want to accomplish in 2025. You know, this is a new year. Trying to put it into action, and reach out to Christy and I, and we'll see how we can help you out.
Yeah, absolutely.
You're going to get a little, I guess, review questionnaire. And if you have any questions after this webinar is done, or you want to contact us, please do take some time, give us some feedback, fill that out. And we look forward to seeing you guys on the next webinar. Thank you so much for joining us, and we hope you guys have a wonderful evening.
Thank you.
Bye-bye.
Bye.